Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. So Trent Limited stock just took a serious hit, dropping 11% in a single day. Why? Well, at the recent big meeting, the AGM, the company basically spilled the beans. Their growth for the first quarter of this financial year is looking to be only around 20%. Now, that's a pretty big deal when you consider they've been cruising along at a 35% growth rate for the last 5 years. No wonder investors got spooked. See, when a stock is constantly trading at a super high price to earnings ratio, like over 100 times earnings, it means everyone's expecting massive growth. The second that growth does not quite hit the mark, things can get ugly fast, just like what happened with Trent. Now, I actually wrote about Trent back in November 2024 when the stock was already down 20% from its peak. Even then, I was saying the risk reward just did not add up for investors. My thinking was simple: a company trading at such a sky high P multiple can't keep that up forever. Super fast growth periods don't last, and there's always competition ready to swoop in and mess with your profits. Now, I didn't actually go visit Trend stores or hit up those busy Zudio outlets. My take was all about basic investing smarts and business strategy. And that brings me to something I like to call astronomer versus astronaut way of looking at investing. Yes, astronomer versus astronauts. Now, you remember the first ever Jurassic Park movie? Well, I was a teenager then, and that movie was mind blowing. It kicked off a whole series famous for its amazing special effects and those intense dinosaur showdowns. But I also loved the clever dialogues and conversations between the main characters. Now, there's one conversation in Jurassic Park 3 that's always stuck with me. Dr. Alan Grant, one of the main characters, talks about two kinds of boys: those who want to be astronomers and those who want to be astronauts. Now, astronomers study cool stuff from a safe distance. But then the kid points out that astronomers don't get to have fun and go to space. Dr. Grant's response? Exactly. That's the difference between imagining and seeing. Now, basically, some prefer thinking and dreaming, while others are all about seeing and doing. I totally believe you can split investors into these two groups: astronomers and astronauts. Now, astronomer investors are the ones who do all their homework from the desks. They dive deep into company reports, financial statements, listen to earning calls, and use different theories to figure out if a stock's worth buying. Warren Buffett, the Oracle of Omaha himself, is a classic example. He's said many times he prefers to read about companies rather than visiting factories or meeting managements. He is definitely an astronomer. Then you have guys like Peter Lynch, who was much more of an astronaut. He was famous for being out there visiting factories and really grilling company management. He wanted to see and observe things for himself, adding what he saw on the factory floor or in a busy restaurant to his knowledge of the company's financials. Now, here's the cool part. As these investing legends showed us, both approaches can totally work. If you've got the right theories and a solid investing game plan, both an astronaut and an astronomer can beat the market over the long term. Now, my call on Trent, made from my astronomer perch, was that its super high valuation was just asking for trouble, especially with growth slowing down and competition always looming. And well, Trent's recent news kind of proved my point. Now, what's interesting is that not everyone's down on Trent right now. A lot of analysts still have a buy rating, even though some have downgraded it. These are the astronauts who seem to think that despite insane 135 times price to earnings ratio and slower growth, there's still a good chance for investors. Maybe they've seen or observed something an astronomer like me missed. But here's something to keep in mind: even awesome astronauts like Peter Lynch were super careful about paying price to earnings or PE ratio over 25 to 30 times, even for the fastest growing companies. Lynch always said paying more than 25 times was a really risky move and you should avoid it at all costs. So the big question is, will the astronauts who are bullish on Trent at its current sky-high PE be proven right in the next couple of years? Or will the astronomers like me who argue that at these prices the stock is likely to underperform win out? What do you think? Are you more of an astronomer or an astronaut when it comes to your investments? Let me know in the comment section. This brings me to the end of today's video. I'll see you again next time. Goodbye and happy investing.